You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
All right, welcome back, everybody. Welcome back, Brandon. Welcome back from your holiday.
Hello.
How are you feeling? Are you feeling relaxed? Are the stress out of the neck it's gone away?
Stress out, yeah.
Shoulders feeling good?
I actually do feel more relaxed. I was getting a little bit overworked before I went on holiday.
Yeah.
So it's always nice to have a break and come back feeling refreshed. I do feel a little bit refreshed, although I am a little bit tired, specifically today.
Yeah.
It's not really I was in Fiji, so it's not a big time difference. It's 2 hours. It's like being in New Zealand. It's not a big time difference, but
yeah.
I think it's because I had a plan to be a little bit further ahead by the time I left, and I didn't quite get there. So when I came back, I was like I got in at 9:30, not yesterday, the day before. Got in at 9:30 p.m. And then I went straight to sleep, and I woke up real early, and I went straight into the office to work on the next video to get it ready. So yeah,
straight back into it.
It's all good.
Yeah,
it's all good.
What kind of what kind of holidays do you guys usually take? Because there's people who take they'll schedule in every single minute of the holiday, and then there's other people who I'm the kind of guy who would go to Fiji and just absolutely do nothing, or maybe pencil in a couple of things every couple of days, but most of the time just sitting down and just relaxing. I don't know, what were you guys up to?
I'm a mix because I don't want to go to a place like Fiji for a couple of weeks and then just be like, oh, I went there and I did nothing. And we went with another, with some of our friends, another couple, and they're very active. They like to get out and do hikes and go to waterfalls and that sort of thing. So we did a lot of that. But yeah, I think if I have it my way, I do something like a full day thing or a half day thing every couple of days, and then I just kind of chill out.
Yeah.
Because I definitely want my holidays to be like a time to unwind.
Yeah.
Because I'm just both of us, we know what it's like. We're just constantly, when you run your own business, anyone that runs their own business knows what it's like. You're just constantly working.
Yeah.
You always, it falls on you.
Always just problem solving, and you don't want to go on a holiday and just be problem solving on the holiday.
Exactly.
And it can kind of get like that, but you do want to kind of make the most of it. So it's this kind of balance you've got to find between downtime and sightseeing and taking advantage of where you are. So.
And now you're jetting off too. You're jetting off next weekend.
I'm going away next week, yeah. So I'm going to New Zealand.
Back. Now you're out. Where are you off to?
I'm going to New Zealand. So I'm just going to go skiing for a week. There's a music festival on in Queenstown. So go there, ski.
Sweet. What's it called?
Snow Machine. So.
Oh, okay.
Yeah, so it should be good. I went skiing a few weeks ago to kind of practice a little bit, but I'm still a bit sketchy at it. So we'll see how I go.
You're not a great skier?
I'm okay. I can pick it up the basics kind of easily, but doing difficult runs is not something I'm very good at. I can't slow down.
Can't
if
you?
it's really steep.
No, I get that feeling as well.
Yeah.
When you just when you go straight and you gain too much speed and you're like,
what do I do?
You try and turn. Yeah. No, I get that feeling as well.
Yeah.
But yeah, anyway, that'll be interesting. How long are you away for?
Almost a week, I think. So yeah, I'll be
nice. Probably
probably quite sore after that week, but it should be good. I'm looking forward to it. So
nice. Yeah. Have a good time. And we'll miss you on the podcast, or it depends what we do. We'll have to figure that out.
We'll figure something out.
Watch the space. Yeah.
We'll once again,
out.
who knows what next week's podcast is going to look like? It's a mixed bag.
Will we be here? Will we not be here?
I mean, we've maintained the consistency, which is something I feel like in the first year when we did the podcast, we would just take weeks off, which is fine. I mean, that's okay for a podcast just getting started, but I feel like even though it's been up, me and Tom, and then it's been kind of mixed around, at least we're still doing it every single week at the moment. So
there is a value in a podcast. There's a value to consistency.
Yeah,
it definitely is a value.
Yeah.
Because I mean, I almost want it to be consistent, because if people are willing to, every whatever it is, Friday night our time or Saturday morning or whenever it might be your time, if you've got if you're supporting us and you're like, oh, it's Saturday morning, I listen to the Young Investors podcast, and you go to look at it and it's like, oh, there's not one there, then that's just not a great experience.
Yeah.
For people that actually do want to, they want to listen to our podcast, then I feel bad if we haven't kind of got something there for them.
Yeah.
But yeah, anyway.
Yeah,
enough of that.
Yeah, what have we got? We've got a little bit of catch-up news to cover on kind of inflation and the Federal Reserve. There's a couple of things that did happen this week that is news, and then kind of related to those things, there's a couple of news items that I'll kind of tie into it in regards to European, UK inflation as well that I kind of want to talk about. What have we got? We've got a story around China.
Yeah, China, big clarification on economic policy stuff. So I'll talk about that. We will talk about Bed Bath & Beyond, the meme stock.
Yes.
Have you seen what's been happening to the price recently?
Oh, boy.
Triple BY?
Disaster.
It's not... Yeah, it's been a
Mr.
disaster.
Ryan Cohen is in a little bit of trouble.
We'll talk about that. That's an interesting story. Couple of Q&A questions, and then that hopefully should round out a pretty good podcast.
Yeah.
All right, so let's do it, eh?
With that said, today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker or using Excel, or you can do it one by one. And once you do that, it will track all the gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used to track the performance of your portfolio, as well as used at tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, track up to 10 holdings for as long as you want, or you can also use that link to sign up to a premium plan. And if you do that, you'll get 4 months off a yearly subscription. So go check it out. And as always, thanks to everyone who uses that link when signing up and is supporting the podcast. Even if you just sign up to a free account, it helps us out. So I appreciate it.
All right.
Where should we begin?
Yeah, I had very bad internet while I was in Fiji. So I've literally, it was so bad that you try and load a web page and you sit there for a minute and then you get so infuriated that you just give up.
Yeah.
Well, so I'm literally trying to catch up with everything that's happened. So I'm going in completely blind. So this Eurozone inflation stuff we're going to talk about, UK inflation, I've actually got zero idea of what's happened.
That's a good thing. I think that's a good thing that you don't have like good internet on a holiday. You want to just kind of check out for a while. As long as nothing
forced to check out.
Yeah, as long as nothing crazy happened, which nothing really, I'm trying to think, nothing insane. No.
The world's still here, so that's something.
Yeah, exactly. There's nothing.
No major wars erupted or anything like that.
No, just the ones that are ongoing. Yeah, nothing. No, so
anyway,
I'll take us through kind of the inflation data. So we got, I think this came out this week. So we've got new Eurozone inflation, which hit a new high of 9.1%. 9th consecutive increase in annual inflation for the Eurozone, which is, of course, made up of a number of European countries. And I'll talk about kind of the breakdown into some of the specific countries because some of those regions are very different within the overall kind of umbrella of the Eurozone. So it kind of makes sense to look at country by country as well.
Sorry, I had to clarify for myself. Officially called the Euro area is a monetary union of 19 member states of the European Union.
Yeah.
That have adopted the euro as their primary currency as the sole legal tender. I didn't actually know that. That's what. There you go. That's a gap in my knowledge that I've now filled.
Yeah,
sweet.
So, and then of course they have the kind of European Central Bank, which is kind of the monetary institution that overlooks, all of those countries. Which, again, it's an interesting situation where you probably have some very, very different economic situations happening in different countries. So it seems strange to have economic policy, a monetary policy that goes out broadly across all of them. But it's the way that it's done. So, anyway, in terms of their inflation, I guess we all probably know what the highest contributor to that record inflation was. It was, of course, energy. Energy was up 38% year over year. No surprises there at all. And the second biggest driver is also probably not super surprising. It was food. Energy and food. Yeah, it's the story of 2022. We've been saying that a lot
lately, haven't we?
It's the story of 2022.
Wait, is this? I think we've already made this podcast, dude.
We've already done this one.
I think we've already said this.
Have we?
We said this like four times already.
Man, you made me panic for a second there. I thought we'd already gone through this.
No, it's just like the story. US inflation 9%, and it's because of
it is kind of
energy
like
and food.
It is. It is a little bit repetitive. So I won't stick around too long on kind of the broad numbers. But in terms of within kind of different European countries, it varied massively. The French inflation rate actually decreased to 6.5%. Down from 6.8%. Spain also had slowing figures, which came in at 10.3%, down from 10.7%, so slowing, but very, very high. Germany saw its inflation reach its highest level in almost half a century of 8.8%. And then in terms of the countries that have the highest inflation in the Eurozone, Estonia currently has the highest rate at 25.2%. Lithuania has 21.1%, and Latvia has 20.8%. And then on the bottom end, you have Malta and Finland, followed by France, which with the lowest rates of 7.1% and 7.6%. So you can see what I mean. Like they're both really, really high, but 7%, 25%, that's where monetary policy is going out equally across those countries.
Yeah.
And it's at 25%, you're thinking, where's Volcker? Where's the 20% interest rate? Whereas at 7%, maybe you're not quite there. Maybe you're still thinking incremental increases. So it is.
Imagine like rewind the clock a few years. And you hear that line that you just said. And on the lower end, we've got Malta and Finland, followed from the lowest inflation rate, 7.1%, 7.6. You'd be like, what?
It's just 7%. It's all right.
Yeah, it's like, oh, now we're like conditioned. 7%. We're like, oh, that's the lower end. That's all good, no worries.
Yeah, it is kind of crazy. Yeah, in terms of kind of news related to that, the European Central Bank is expected to raise interest rates. That's not really surprising with inflation at 10% on average. Shocking. But what actually is kind of crazy is the official rate in Europe at the moment is still 0%. And I was kind of shocked by this because I thought, didn't they do an interest rate increase? And they had, but they did a 50 basis point hike from a negative official rate that they had previously. So they've done one hike.
They're on the NERPs.
Yeah, so they've done one hike and they've just gotten it to 0, which is kind of crazy that now they're thinking about the first positive rate hike to get interest rates positive for the first time during this crisis, and inflation is what it is.
Imagine getting paid to take a loan out. That'd be nice.
Yeah, it'd be nice to be a European bank. Well, probably not.
Negative interest rate policy just blows my mind. I still don't really... Doesn't quite click with me, but there you go.
Yeah. So, I mean, it's not as if, other bonds are negative rates. It's simply the overnight borrowing rate for banks. So I'm not, I'm not an expert in this field. We have to get someone else kind of on to talk about that.
Yeah.
But banks have to essentially, balance and have, the amount, certain amounts on their books. And the way that they do that is by borrowing from the central bank at the overnight rate. It is interesting though. It is still a crazy situation to have where, you're borrowing at a negative rate. So you're going to get, you're not even paying interest. You're getting paid to borrow money.
Yeah, it's bizarre. Imagine imagine a salesperson comes over to your house. It's like, hey, we want you to buy this house. We're going to give you a big fat loan, and we're going to pay you to do it.
Like, please take this money.
please take it.
Yeah.
Anyway, there you go.
Yeah. So
interesting.
I'll just
you're right. There's a very interesting dynamic as to how they all get affected equally, but it's obviously different situations in different countries. So
and
it's an interesting system, isn't it?
Yeah, and I'm not an expert in Brexit or anything like that, but I imagine I think that's probably one of the key reasons why the UK wanted to move out of the European Union, to not be kind of applied broadly, but rather have kind of monetary and other controls that are more related to the people who kind of live in the area, because the cultures are so different from place to place. It does kind of seem strange. I mean, even within a country, cultures can shift massively from state to state. So,
True.
Yeah, you can imagine across the whole of Europe. But in terms of the UK, so this was 2 weeks ago, but there is a story that happened just this week as well that I'll tie into it. But their inflation numbers came out 2 weeks ago. They reached 10.1%. So they've crossed the barrier. We're in double digits territory now, up from 9.4% last month. So still going full steam ahead. Can you have a guess at what might have been the biggest contributor? I know it's a difficult question. You're not an economist.
Can I guess? Can I?
Yeah, have a go.
Energy.
Wait, is that right? Yes, energy. It was. Well done. No. So petrol was the biggest individual item, which was up 45% year over year. So again, yeah, I feel like I'm telling the same story over and over again. And in the US,
That's
energy
right. I
up
like
40%. So if that wasn't bad enough, Goldman Sachs did an analysis, and this is what came out this week, and they believe that UK inflation could hit 22.4% next year.
Wow.
So they're quite bearish on what's going to happen with the UK, and the reason for that is essentially there's already, of course, a serious oil and energy crisis, and demand as the UK moves into winter, and that part of the world moves into winter, is only going to go up for energy.
Yeah.
And as a result, if the supply chain issues are not eased, then there'll continue to be even more pressure on prices.
Yeah.
So,
yep, this is going to be interesting.
Yeah.
I'm kind of glad that I'm not over in the UK as I lead into this winter that they're about to have.
Yeah.
Yeah. It would be nervous times.
Yeah, and I mean it's funny because Australia, well, it's not really funny, but Australia seems to be managing somewhat well during all of this. I mean, if you look at the different regions, we feel like we've been quite lucky. I mean, what's our inflation at 6% or something, and then you have the US at almost 10, and everywhere else is 10 or above. So it is interesting, kind of looking out around the world and at some of these areas that are just have more exposure to the energy crisis. Unfortunately,
yeah, for sure. Yeah. All right.
And then should I keep going on? Should I?
Yeah.
I'm not finished. The Young Investors Inflation Podcast is not over yet. So,
alrighty.
No, this one's not really in relation to inflation, but heading back over to the US, there was a Federal Reserve update this week, which you probably have seen because it kind of made news headlines all around the world as it basically crashed every global stock market on this one meeting, which is something that Jerome has the power to do, which is, it's kind of impressive that he could just stand up and talk for 10 minutes and markets drop trillions of dollars. No, tens of billions of dollars. So
it is insane.
Yeah, it is. It's just ridiculous that's what all of these big institutions that manage so much money are just kind of paying attention to so closely.
I want to know what's in Jerome's stock portfolio. Forget Pelosi.
Yeah, what's he got? Yeah,
what's he got? What's he got hiding away?
Yeah, gee, that would be great. But anyway, so last week I should say, he gave a speech at the annual Jackson Hole conference. He said a couple of things that stood out. He said reducing inflation will likely require a sustained period of below trend growth and some softening labor market conditions, and would bring some pain to households and businesses. He said US rates are going to have to increase further and remain elevated at elevated levels for longer. So, he's obviously.
Come on, Jerome.
He's starting to.
Can I just say why would he say it's going to bring some pain? I mean, come on, Jerome. You know how to phrase these things. You need to say some softening to the comfort of households and businesses. That's what you need to say.
A reduction in comfort.
A reduction. Yeah. No, not even a reduction. Reduction sounds bad.
Yeah,
you just need to say softening of comfort.
Temporary.
Yeah. Well, transitory softening of comfort of everybody's bank accounts and stock portfolios.
Yeah.
For the next 10 years. Sorry, I cut you off there.
No. So
As consistent with kind of what he's been saying, he's just saying it with a little bit more
he's
decisiveness, I guess.
Yeah, he's got that slow ramp of slowly saying things a little bit more dramatic. Just slightly worse.
He's acting like the Federal Reserve should, do things slowly, don't upset, up, down, slow.
Yeah.
Although really in the grand scheme of things, they're acting very quickly.
Yeah, and I mean,
anyway.
I think one of the most important things that he mentioned during this meeting, which probably had a big impact on the market, was he actually mentioned the Volcker 20% interest rate situation from the 1980s. He brought it up and he said, this is the quote, he said, "Our aim is to avoid that outcome by acting to resolve now." And I think why that's concerning is because he always kind of, not that he's intending, or I'm sure he's certainly hoping to avoid that, but he's actually mentioned it now, which means, which is kind of the first step. You know what I mean? It's like, it's like he's always like, it's transitory. And then he's like, it might not be transitory. He kind of like, he works his way towards like, so he has like a track record of like a year where he's like, I've been saying this for a year. Why are you surprised? So that's why
the next speech he's going to do, he's going to mention it twice.
Yeah.
Then the next one after that, he's going to mention it 4 times.
Yeah.
And then the next one after that, he's going to do a Volcker style rate hike.
Yeah, exactly. Yeah. So 4 months out, that's no. But yeah.
Yeah. Yeah. In 4 to 6 months, watch out.
So I thought that was interesting to hear him actually, recognize and mention that. And it is interesting because this was the same speech that he made last year. And last year, he was categorizing inflation as transitory. So it's kind of crazy how far we've come in just 12
months.
Well, I shouldn't say how far we've come. It's not like we've improved. What has changed over 12 months from, it's transitory to now it's spiraling kind of out of control.
Volcker.
Yeah, exactly.
Back in the 1970s.
Have you heard of 1929? Buckle up.
Oh dear. Oh, have you heard of 1929? That's classic. Oh dear.
So there we go. The market hated it, of course, which is kind of surprising because, I feel like his rhetoric has not been too different, but I guess in the context of inflation declined for the US last month on the last reading, everyone was just so optimistic about that. So there was so much consensus that inflation has peaked. So the fact that Jerome Powell is saying that now about interest rates when we're about to get the next month's data for inflation in the US, it kind of makes sense that people would have a shifting opinion. But that's why you should never just look at one decrease in inflation or any figure and think that that's the peak. That's kind of a silly way, I think, to view these situations. And we ultimately just have to see the data come out to find out what's going to happen.
All right. Is that all we had to talk about there?
That's it. Got it all out of the way.
That's it. That was a lot. That was like 3 different stories.
And to be fair,
all worthy. Sorry, yeah.
Just to be fair, that was like 3 weeks of stuff that we had to kind of rehash and cover because we had.
Well, that's what I needed.
Yeah, we needed the refresher.
Because I've been away.
You needed to be reminded as soon as you came back from Fiji, from the sunny Fiji. You needed to be reminded the world we're living in right now. It's a disaster, okay?
It's an absolute
Don't forget,
disaster.
You're looking out over the sunrise thinking life's great. It's not, okay?
Tell you what, though, the sunrise and the sunsets, they were pretty good.
Yeah, I can imagine.
Anyway, Fiji. I'll come back soon. All right, let's move on.
Yeah,
let's talk about China. China is set to convene a historic meeting on October 16th. Here's what to expect. That is the title of the article. So this is interesting. I didn't really know that this was coming up, but there's a couple of interesting points that we should talk about. It says China's leaders are set to convene in Beijing on October 16th for a major political meeting that's expected to consolidate President Xi Jinping's power and signal forthcoming economic policy. This year's gathering takes on additional significance as it's become a widely watched marker for when China may begin to ease its stringent zero-COVID policy. The Communist Party of China's top leaders are expected to propose that the party hold its 20th National Congress on October 16th in Beijing, a state media announced on Tuesday. It's, quote, the most important political event of the decade in China, City analysts wrote in a note last week. Quote, the Congress is set to launch a new political economy style, the City report said. Quote, in the near term, it may help reduce policy uncertainty and allow Beijing to refocus on economic development. Right. The National Congress is held every 5 years and is primarily a political event to determine the next group of leaders for the ruling party.
Right.
So, okay. Yeah, interesting.
So I guess they get together and they, like you said in that last kind of line there, they just decide maybe a new strategy and where power and who's going to be in control and that sort of thing at the top of the country.
Yeah, it seems like it.
Yeah.
Seems like they come together, discuss everything, figure out what they're going to do.
Yeah. I don't really understand the Chinese political system, I'll be honest.
Oh, no, me neither.
Yeah, I that's all I got. I don't really understand it. It would be something interesting. I should look into it and kind of learn about the history of China and how their political system has evolved, because I do find politics quite interesting, and it is such a dramatic difference from what we're used to here. So even just to learn about it, I think I should do that.
Yeah. No, 100%. All I know is that the CCP is in power, and Xi Jinping abolished the 2-term limit, I think it was, in 2018.
Right, okay.
So
this is him going. Is he going to run again?
Is he going to run again? Is he going to get? I think so. I think he just might.
Yeah.
He might just beat the opposition,
Might get
out. So what else did this article have to say? The expected mid-October Congress also puts a tentative date on when China might ease its so-called dynamic zero-COVID policy. Quote, we expect the zero-COVID policy to be revised after the meeting in October, which will help the economy to normalize. Jiwei Zhang, president and chief economist at Pinpoint Asset Management, said in a note, while most of the world has relaxed Beijing's attempt to maintain a policy of few to no COVID infections has restricted business activity domestically and kept national borders largely shut for more than 2 years. And that's kind of why I just wanted to chuck this in here, because this could, I guess, have quite a good clarifying kind of impact on a lot of the things that we're stressed out about over here, because this could give us some signals on whether the supply side, the supply constraints might end up easing, because of course China is the global manufacturing hub. I think in 2021, 30% of global manufacturing output happened just in China.
Wow.
So, and obviously I know that even though there's a zero COVID policy, there's obviously still been a lot of manufacturing. There've obviously been people working in China. It's not like a crazy shutdown anymore, but it could, if they come out and say, look, zero COVID policy got our cases way down. We're comfortable with that. Now we're going to really get back to business. That could be a big impact, or that could potentially have an impact on the whole choking of the supply chain that we've all been talking about, that's leading to this massive inflation, blah, 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 blah.
Yeah.
The stuff that we've been talking about for a long time. It may also, this is kind of a side note, which won't be relevant for everyone. It may also give us clarity on policies around China's economy, and thus policies around a lot of China's big businesses, which is affecting obviously a lot of international investors that have been buying into big Chinese, companies like a Tencent or Alibaba, that sort of thing. So there might be clarification around economic policies that in turn gives us clarification around investments that we might have in Chinese companies. So there could actually be this is kind of something that you could just breeze past in the news, but actually this could actually have some significant impacts to kind of what's going on at the moment. I think.
It is interesting to watch because I mean my kind of perspective on the China situation has been from my corporate travel investment, which if you look at their revenues in all of these other regions, they're almost back to normal or exceeding them with businesses traveling even more. And then you look at China, which is corporate travel businesses mostly make money from international travel. It's like a fifth or less of the activity still. So it's going to be my like kind of investment perspective on the dramatic impact that it has, and it is such a global hub for not just manufacturing, just for business in general. It's such a big part of the economy, so you would hope that with some easing, it will have a positive impact. It's hard to imagine that they would have ever achieved a zero COVID. I mean, even if they open up, I mean. Isn't it just going to go in? I'm not too sure about their strategy there, but I guess we'll see whether they like just neglect it or whether they open up and then they close down again. We really don't know if this is actually a turning point. It might really not be. It might be just a few week turning point and then it might go back.
Yeah. But that's the thing as well. This has always been the case. It's like, you get the health benefits from having, lower COVID cases, but you also get the economic pain of lockdowns and not being as per usual. So you also have to like put China in context with the rest of the world. If like all the rest of the world or most of the rest of the world is like, okay, everyone's pretty much vaccinated, we've got booster shots and everything. Now we're going to open back up and let our economy really push back to normal. But China is still like, oh, no, we're going to lock down. Yes, our economy's going to suffer. Like, they would be feeling the pinch. It's like, wow, everybody else, their economy's getting back to normal, and we're still putting self-imposed pressure on our economy. Yeah. Yes, I know there's obviously health benefits because less people are getting COVID. It's not spreading as much and that sort of thing. But that's obviously a trade-off that people are like, whoa, maybe we should, like, we're losing too, or we're losing too much ground, or we're letting the gap close, or whatever. However you might look at it. So they might just be like, okay, we did well. Now we got to get back to business. Yeah. So who knows? Anyway, that's all I had to talk about with China. Interesting. So look out again? In the news, October 16th.
October 16th. Oh, okay, so about a month and a half. We'll see what
comes of it.
See what's cracking with China.
See what's cracking. You want to talk about Bed Bath & Beyond?
Yeah, take us through.
Oh my gosh. We've both got our own things to talk about with this, don't we?
Yeah, and we're a little bit late to the party. I mean, this is kind of a couple week old story, I think. But yeah, it is such an interesting. It's kind of a meme related stock, and it's got some pump and dump allegations involved. It's such a spicy story that's got a lot of retail investors entangled in it as well, that I think it's worth revisiting.
I want to talk about it from the meme stock aspect.
Yeah.
Because in August, if you don't know Bed Bath & Beyond, in August, this stock went up 275% in 2 weeks. 275% 2 weeks. Okay, not a bad return, but clearly just meme stock. This one's been a meme stock before, and it's back. We've seen a couple of other resurgences of meme stocks in the other ones as well.
Yeah.
However, now it is crashing. It is down 58% since the peak on the 17th of August. And this is just what I wanted to talk about with meme stocks. I was just scrolling Wall Street Journal this morning, and I saw this article. It says, from the Wall Street Journal, Bed Bath & Beyond said it would close roughly 20% of its namesake stores, cut its workforce, and bring in fresh cash to stabilize the business through the holiday season as the retailer confronts plunging sales. The home goods seller is attempting to trim costs and raise money as it tries to correct recent operating missteps and navigate a challenging economic environment. It has been burning through its cash reserves for several quarters, and a shopper exodus has shaken investor and vendor confidence. On Wednesday, executives and directors attempted to assage its uneasy partners. In a business update, they said the company secured commitments for more than $500 million in financing. It could potentially sell as many as 12 million shares of common stock to raise money. They also pledged to overhaul the assortment of goods in the company's stores, focusing more on national brands after spending millions to develop private label goods. But I was just reading that, and I'm like, man, this is just in like the meme stock, this is like, it just showed me like the stupidity of the meme stock movement. It's like, if you're, why would you ever want to buy a meme stock? Just because there's a risk that you could be the poor sod at the end of the day holding the bag. And if you're holding the bag, then you literally hold this stock that, as Wall Street Journal is noting, is doing really, really, really bad.
Is that bad? It sounds like they're doing great. Closing stores, burning cash. These are things that, these things are great.
These are the things that signal that the stock's about to go up 100,000%.
What do they say? It's the darkest before dawn or something like that. So
oh my God, Hamish. Don't you start, mate. Don't you start.
No, but it is interesting.
It shows you the danger in being a meme stock investor.
Yeah, and look, I've kind of been covering this a little bit with regards to Amazon. I was looking back over Nick Sleep's letters, who invested in Amazon early days, and he kind of indicated how Amazon just had this obsession with lowering prices so much that in some cases the businesses, the brick and mortar retailers, even if they operated at a loss, Amazon's prices would still be lower. And the result of that powerful advantage is that they just bleed customers to Amazon over time. There'll be periods where they can lower prices and operate at a loss to try and retain customers, but as a net, they're not going to be able to match them on price. So they just bleed customers. And I don't know about this company. I honestly haven't looked at this company in a huge amount of detail, but I would imagine somewhat of a similar thing is happening, where a lot of the products that are available in the store are basically, you're paying a premium for all of the inefficiencies that come with a physical retailer. That's one aspect. And then just the fact that Amazon is so much bigger and is so much more efficient, and the service is so much better. And if you're a Prime member, you get all these other things. You get the Prime Video. So it's it's just the reality of, I think, Amazon being in such a powerful competitive position relative to some of these older style businesses.
So yeah, there you go. Interesting fact: as of Wednesday, the company's market value is roughly $750 million. As at its peak in June 2012, the company had a valuation of more than $17.3 billion. 17.3 billion is down to 750 million. But hopefully, if this doesn't show you that it's silly to be a meme stock, I imagine just being a guy that's like see BBBY go up 275% in 2 weeks. Like, oh, here we go, meme stock to the moon, babe, and you just buy. And then what have you got now? You've got this this business that's crumbling, and you're also down like 58% in just 2 weeks.
Yeah, and I mean that's look. I mean, there's certainly trading strategies that probably work. It's not an area we kind of look at, so who are we to say? But that is an element of these trades, these betting on stock price movements. That's the risk, right? Is that if it doesn't work out, you can't just be like, oh, I'll just hold it for the long term, because there might not be a long term for that business. Whereas,
exactly.
If we're buying a great company and the stock price surges, it's like, oh, goody, and if it crashes, who cares? It doesn't really matter what happens over the course of 6 months, because the underlying business is strong. So, that is the risk with these businesses.
Power of being a long-term investor, hey?
Yeah, and look, it is surprising, I think, that through how much turbulence there's been in the financial markets, that these stories continue to happen. I guess they're happening to a lesser extent, right? Like these meme stocks. It's definitely not.
The environment is much harder for something like a fresh new meme stock to kind of, because it's just like everything's getting rougher, like macroeconomic environment, in rates going up. It's just harder. Like we had the perfect conditions like a year or two ago, for these things to run rampant.
Yeah.
But the actual conditions are much harder now for these things to occur.
And the thing is, even with some of the meme stocks like GameStop and that sort of thing from a year and a half ago, it's so much easier for them to get capital. The interest rates were far lower. Stock prices were higher, so they could issue shares at a higher price. Everything now is, as you said, it's just a more difficult, not just on the turbulence of the markets, but in terms of the business actually getting capital to survive, which is a critical thing for these dying businesses. Is can they get a loan, and can they get a loan to replace that old loan, and can they issue a bunch of shares and call them ape shares for some reason?
Dear. What? Who was it?
AMC.
What meme stock did that?
AMC has gone off the deep end. They're the gold mine. They've got the 8 share. Like they've just gone full meme. Like Bed Bath and Beyond. I mean, Bed Bath and Beyond is close. I mean, they started an NFT marketplace.
Did they?
So yeah, they've gone full meme. There's this category of companies that have actually given up. Like the founders, not the founder, but the board of directors has gone, look, we give up. The only people who like us are these people on Reddit. Let's just give them what they want. Let's just do all this stuff. Let's get into crypto. let's get an NFT going. Like
gold miner, yeah. The next thing that'll happen is AMC will change its ticker to MEME. And that'll give it a 1 day return of like
is there a
one I don't know.
Is there a stock with the ticker meme? Because
I don't know.
If there isn't, I don't think there is.
No, maybe not. But that's the thing. If you type into Google like meme stock price, it'll probably just direct you to something else.
Yeah.
Ticker meme.
I don't know. I couldn't find anything. Just came up with a bunch of rubbish.
Hang on. There's a Round Hill meme ETF with the ticker meme.
Right. Okay.
On New York Stock Exchange.
There you go.
NYSE Orca. I don't know what it does. How funny would it be if it just invested in meme stocks? Oh my God, it does. The index seeks to track the performance of meme stocks. Oh dear. Meme stocks are equity securities of companies that exhibit a combination of elevated social media activity and high short interest, both of which are indicators of market sentiment. Under normal circumstances, at least 80% of the fund's net assets will be invested in meme stocks.
Yeah. I know we're not supposed to try and time the market, but this isn't the bottom. This is not the bottom. This is not it. Oh boy.
Gosh, that's funny. It is non-diversified. There you go. Round Hill meme ETF, everybody.
Did you have anything else to cover, or should I?
No, I want to throw it over to you because that's kind of the meme stock part of the story. But there's also the controversy around Ryan Cohen.
Mr. Ryan Cohen, yeah.
Yeah, please take us through.
Yeah, no, I hadn't really been following this super closely, so when I saw the name Ryan Cohen, I thought, where have I heard that name before? Where have I seen this man before? Ryan Cohen, of course, is he's the chairman of GameStop. So before that, he founded Chewy, which was this online pet store. He then sold that company, took a bunch of that money, invested it in GameStop, and brought some people onto the board, and came over to GameStop and has been kind of leading the charge, I guess, in trying to transition that business out from the dying business that it is to being something online that can survive. He is very much involved, or I should say was, in Bed Bath & Beyond. And it's kind of a crazy story around what happened. So he basically came to the company in January, so just 7-8 months ago, with a promise to help kind of improve the company. I guess a similar thing to GameStop. He wanted to buy a chunk of investment in the company, maybe bring some people on the board, and just force some change on the board by using his money as influence, taking somewhat of an activist kind of investor role. He bought 10% of the stock, and he bought 3 people onto the board. So this is, that's quite a significant change to do to a company, right? Yeah. He's not a passive investor in the business buying, he's not a Buffett where he usually just buys a few percent and lets the management team go. He's buying a big chunk. He's bringing people on the board. He's pushing people off the board. And within 6 months, he was out. He's gone. He's clear of the investment,
wow.
Which is kind of interesting when you come in and make so many kind of influential changes. And it doesn't end there. It was some very interesting kind of filings that he made that makes it look like he might have pump and dumped this stock.
Give the man a YouTube channel.
Yeah, I know. What's he doing? That's so like off. He's taken a leaf out of the YouTube space. Not us, of course.
Oh gosh.
So essentially, okay. So
we won't get into that.
No, we won't. We won't get into that.
We'll leave that one where it is.
Yeah, get too angry on this podcast.
Yeah, we can't. Yeah, I don't want to. You full anger is scary.
Yeah. So essentially, so he bought this investment in the company 6 months ago. And then in early August, Bed Bath & Beyond reported earnings. And I think you just spoke about some of it, and it was awful. It was terrible earnings. I think the stock went down significantly. And just, I think it was a week after this, he filed what's called an amended 13D SEC filing. And this filing essentially showed that he still owned the stock. In fact, it showed that he owned a higher percentage of the stock than he did at the start of the year. So he made this filing, it came public, and the stock surged. And I think that's what you were describing, this massive kind of push that happened in early August. Where it peaked out on August 17. Then 2 days after August 17, so August 19, another SEC filing was filed. And this showed that he had sold the entire position. And the crazy thing about this is that filing needs to be made within 48 hours of selling your shares. So on the filing, we can see that he sold his entire position on the day that the stock peaked. That's the first thing. But it was also the same day that he publicly filed an amended SEC filing that showed he owned the stock. So it looks like, just to kind of summarize it, it looks like, and obviously this is allegedly, it looks like he filed a 13D to show people he still owned the stock, to make the stock go up, and then that same day, he sold his entire position and then had to report about that sale 2 days later. So, yeah, kind of crazy. Yeah, go on.
That's insane. Although technically, that's like fair game, right?
I mean, yeah, it's fair game, but, well, I mean, I guess unless you're trying to manipulate the markets, right?
He is manipulate. Yeah, that could be deemed as manipulate. That's correct. But if you just looked at the letter of the law, he's just using the reporting windows as like an arbitrage, like he's exploiting the rules around reporting for his own personal gain.
Yeah, I guess that's pretty fair. Yeah, like he had to make this other filing, and he just used that as an opportunity to get out of the stock. It does look terrible that it was the day the stock kind of peaked.
Yeah, it looks horrific.
It also, in the context of someone who, again, as I said, 6 months ago, they bought 10% of the stock. It went up to 12% ownership eventually, and he put 3 people on the board. So that's, he went in and like, it's like joining someone's family and just messing around in there and then just ducking off 6 months later. Like that's not it's not like he was an outside investor. He went in there and made changes, which is kind of massive. The other kind of funny thing that came out of this, and if you're on Twitter, you probably saw this. He was getting absolutely destroyed and still is, because in June of 2022, he tweeted, and there's this screenshot of this tweet going around. He tweeted, "I'm sick of failed executives making million in risk-free compensation while shareholders are left holding the bag," which is ironic because he could be labeled as a failed executive who's left shareholders holding the bag. He's getting absolutely dragged.
Risk-free compensation. Yep. Tick. Shareholders holding the bag. Tick.
Yeah.
God damn. He should have just said, I'm sick of people like myself.
Yeah. Strap in next month.
Yeah. And by the way,
so yeah, there you go. Not a great situation. He's very, very negative press around him, and I would imagine it's going to be difficult for him to get public opinion back on his side after doing something like that.
No chance.
Which is interesting because he's still the chair of GameStop. So what happens with that will be interesting to kind of see. But there you go, crazy meme story.
There you go. Yeah, that is indeed. That does look pretty bad. I don't think we've heard the last of this.
No,
that does sound pretty bad. All right, Hamish. Shall we move on to some questions and answers?
Do some Q&A. I think we've.
By the way, as always, if you have a question that you would like to ask, just head over to the YouTube version, or I don't know, have we tested out that Spotify functionality yet?
Yep, you can ask on Spotify.
Okay.
So, yep.
You can ask on Spotify as well. So YouTube or Spotify, drop us a comment, or I think there's a question box or something on Spotify. And we will chuck the questions into a Google Doc. And we've had some that have been sitting around for a little while, so we'll try and get through a couple. We've got 10, 12 minutes, I think, left. So let me ask this one to you, Hamish.
Yeah.
Hi, great episode. Thanks for the content you are providing. I really enjoy it. Oh, I'm glad we make a podcast that you can enjoy. I have a question about two metrics, ROA versus ROIC. And where does the question end?
This whole thing is the question.
This whole thing is the question.
Yeah.
ROIC equals owner's earnings over debt plus equity, and ROA equals owner's earnings over assets. But isn't equity equal to assets minus debt? Doesn't that make those two metrics the same? Or the difference is that equity incorporates more liabilities additional to debt?
Yeah, it's a good question. And these, ROA, ROE, ROIC, ROCE, they're all kind of different measures of how capital is being invested in relation to profits produced by the business. And they kind of vary in slightly different ways. Just in terms of your question, equity is, of course, total assets minus total liabilities. So it's not just minus debt. So yes, what you said in your question is true. But here's the way you should probably think about ROIC being different to ROA, which is just a measure of profitability relative to assets. So ROIC is, as you said, a profit figure divided by equity plus long-term debt. You can rearrange the bottom part of that formula to be profit divided by short-term assets minus short-term liabilities plus long-term assets, which, if you kind of consolidate that, is profit divided by working capital plus long-term assets. So ROIC is essentially, just to put it in words, a measure of how much profit is produced on two things: the long-term invested capital in property, plant, that sort of thing, as well as the short-term capital required for the day-to-day inventory and paying suppliers and that sort of thing. So ROIC, I think a lot of people will probably say that it's one of the best measures to kind of focus on in terms of in terms of looking at profit relative to money that's actually being invested in the business in order to produce that profit. But yeah, there you go. There's the difference, slight difference. And then there's a lot of write-ups, I think, online that you can kind of find to describe the slight differences between all of them.
Nice.
All right. I'll read you one.
Find one.
Yeah. Hi guys, should we be concerned about the possibility of brokers going bankrupt and running away with our holdings? I've seen a lot of this in the crypto space and would assume the traditional brokers like Stake and CMC markets are more regulated. However, if these privately listed companies, how would we find the data?
So there is, I guess, a possibility of brokers going bankrupt and you losing. You're exactly right. That was the big thing. I can't remember the crypto exchange now.
Voyager.
Voyager. Yeah. I kind of probably Celsius was Celsius.
Celsius was one. I think maybe. Yeah.
Was that something different? I can't remember because I just don't pay attention to the crypto space, to be honest. Depends on the broker. Like some brokers. You're the share owner on the share registry, and that's fantastic. Some of these brokers own shares on your behalf, and you're just like a client of theirs. There's a squillion different ways that companies can try and structure things, make it better or worse for you or them or whatever. So I would just say go to your broker's FAQs, and every broker should pretty much report this in their FAQs and read about it. Like, for example, if you go to Stake, their FAQ, one of the FAQs they answer is, what happens to my shares if Stake goes bankrupt? And they give a very detailed description of exactly your portfolio is insured up to I think it's $500,000. Don't quote me on that. I think it's $500,000 for US dollars for Stake portfolio. So if anything happens to them, then you're all good. But you just need to not assume anything. That's like the best takeaway, is not to assume anything. Just go in, have a look at the T's and C's, have a look at the broker, do your own research and say, hey, look, if this broker goes belly up, what happens to my shares? And make sure you're very confident that you know the answer.
Yep.
But yeah.
Yep. That's
it. Any flavor to add on that?
No, I think that's it. Just ask your broker if possible, and if they have a phone number or they have a branch, so you can actually speak to someone in person, and that gives you more confidence. Then that's always it's not always, but it's sometimes an opportunity that you can, or a thing that's available to you.
Yeah, and this is another gap in my knowledge. In Australia, the CHESS-sponsored holdings.
Mm-hmm.
CHESS-sponsored means the ASX is keeping a list of who owns what shares. If your shares are CHESS-sponsored, it means that when you buy or sell shares, ASX has a record of you owning those shares directly. So I think in that case, if you have a CHESS-sponsored portfolio with one broker and it goes bust, you can transfer your portfolio to a different broker.
Yeah.
But yeah, very, very complicated. But just do your due diligence. Like, I wouldn't apply any hard and fast rules. The only rule I would apply is do your due diligence. Okay, let's ask this. Hey, do you guys own your own place? At what stage did you buy your own houses? Sorry if this is too personal. I'm just wondering. No,
how dare you?
That's okay.
How dare you ask that question? No.
Don't be mean, Hamish. I don't mind answering this question.
No, I don't own my own place. I just still rent. So yeah, I don't know. Renting it's interesting, especially if you work from home and run a business from home and large parts of the property are being used for that business. Then there's quite a lot of tax benefits from actually renting and being able to deduct the portions of the house that are being used if it's large parts. So if you have a studio or something like that. So that's been kind of my mindset when it's come to where I want to live. And the other probably overarching thing is I haven't really found anywhere that I would want to actually settle down and live and commit to living there for a long period of time. So I don't know. I enjoy the flexibility of renting for now. Then we'll see what happens over the next couple of years.
Fair enough. Yeah, I have bought an apartment that is being built at the moment. So I'm currently just renting as well. I do like the idea of owning property in the future, but at the moment, it's like anything. You just think about where is your money best spent. Do you invest it in property? Do you invest it in shares? At the moment, the best place for my money to be invested is back into my YouTube channel and into Profitful. So that's naturally just where my money kind of goes. But yes, I'm currently renting, but I do like the idea of having your own place, having it paid off. So you've always got that kind of financial cushion that you own your own place. So I do like that, but in the future. All right. Hi, Hamish and Brandon. Speaking of the McDonald's, we were talking about the McDonald's Monopoly competition not too long ago. Check out the documentary series McMillions, which examines the $24 million worth of fraud that corrupted the McDonald's Monopoly game. Wow. Between 1989 and 2001, in which there were almost no legitimate $1 million winners in the contest. It's a really good 6-episode series. That's interesting. I'll have to check that out.
I'll have to. I don't know. Does he say where it is? What platform it's on?
No, it doesn't say, but that's okay. It'll depend on what country you're in. That's anyway. True. So I have to look that up. No, that's crazy. There was no legitimate winners.
That's insane.
We were saying it's like the most popular game. That I think it's fast food.
I think it's on at the moment again, right?
Is it? Maybe it's about that time of year, isn't it? Isn't it October?
I feel like I got an ad for that recently.
But let's be real. I'm only in it to get my free small fries.
Yeah, exactly. Yeah. I think it is back. So now we're just doing a sponsor segment for McDonald's, I guess.
There you go.
578 million in prizes.
30th of August. There you go.
Sensational.
All right, we're on.
Yeah, so we'll have to...
This episode is brought to you by McDonald's. You could win millions or not playing McDonald's Monopoly.
So if you get McDonald's and you get, you peel off the little things and you want to send them to somebody, I'll leave my...
P.O. box.
I'll leave my P.O. box.
That's funny. Very good. Yeah, I'll have to check that out. What are some other? Maybe we could use it. What are some other TV shows, movies that we could recommend?
There is a new
stock market related.
There was a stock market related show that came out on Netflix. I haven't watched it yet. I can't remember what it was called though. It looked kind of
that's
not
helpful.
That great. So there's a show.
I tried to watch.
I don't know what it's called. I don't know where you can watch it. It's about stock market, I think. So yeah, there you go.
I tried to get into Succession because I think you recommended that to me, didn't you?
Oh yeah, you didn't like it?
No, I couldn't watch it because my binge app is broken.
Oh. Yeah,
I got 40 minutes through the first episode and it keeps crashing. I literally cannot watch past that point.
Yeah, it's a pet,
and I don't know how.
It's a pet peeve of mine.
I don't know.
Why are they all so bad? Even Disney Plus is not great.
They're Netflix is like the only one that works pretty well.
Yeah.
All the other ones that I use on my TV, which is a brand new TV from 2022. So you imagine that it's all like good quality TV.
Ridiculous.
None of the other ones work properly. They all have some bugs.
Yeah. No, it's stupid. No, yeah, Succession, great show. Not about the stock market, but kind of business related for sure.
Bit funny.
Yeah. Definitely recommend that.
People recommend Billions to me, but I haven't watched through Billions.
I didn't like it. Yeah.
You didn't?
I feel like
okay.
I think
it's just dramatized. It's not real.
Someone said this to me, and I think it's probably true. I think it probably is attractive to people who are not into finance, if that makes sense.
Okay.
So maybe in the same way that Suits is interesting to people who are not maybe in the legal field, because it kind of it just dramatizes the fraudulent really side of those industries, and it's kind of exciting. I don't know if that's actually true. Maybe people in legal fields like Suits, but that's the feel that I got watching Billions, was like, this would be for somebody who doesn't know anything about finance.
Right. So
but I don't know.
It's just like super unrealistic.
Yeah, but I've also heard people say that they really enjoy it. So maybe that's just my like personal, I don't know. Maybe it's just not my cup of tea. So there you go.
Nice.
Yeah, what else?
All right.
I don't know.
Movies. We can go through movies. Obviously, Big Short, Wolf of Wall Street. They're some of my favorites. But Founder, I really enjoyed Founder, which is the story of McDonald's. Yeah. I'm trying to think. There's a good Netflix series called Dirty Money, which is interesting, looking into the dodgiest, like the scandal, the biggest business scandals that the world has seen. Yeah, that was quite good actually.
Moneyball is a good one as well, kind of doing the maths and the money behind, the economics behind baseball, and that
he makes
it's
first
a true
base.
Story as well. So yeah, really interesting.
That's Brad Pitt and Jonah Hill.
That's it. Yeah. Jonah Hill has a relatively minor role in that, and it's certainly a different role from his typical comedy stuff. So
he was good in that. I like that.
Yeah, he was.
There you go. I can't think of any more off the top of my head. There you go. Maybe let us know. Just give us recommendations on business, stock market kind of related movies, TV shows, comedy, drama, whatever. Let us know.
Yeah.
Very interesting.
All right. Should we wrap it up there for today?
Yes.
Thanks everyone for tuning in. As always, as we said, who knows what's going to happen next week? But we'll figure it out, and we'll do our best.
We'll be here.
We'll do our best to serve an
I'll
episode.
be here.
Yeah, you'll be here. So we'll do our best to kind of serve an episode to you next week. As always, if you have questions, Brandon said, head over to the YouTube version and leave them on the latest episode. Or if you're on Spotify, you can just go below and ask your questions there, and we'll try and get to as many as possible next week. Thanks Sharesight for sponsoring as always, and thanks Brandon for joining me.
All good, friend.
And we'll be back next week. Well, I won't be back. I'm gonna go.
Nice.
I'm gonna go.
See you in a couple weeks.
Yeah. Hopefully, I won't break my legs. So we'll.
God, you jinx yourself now, haven't you? Oh, Hamish.
Yeah. I mean, I don't really need them
have
to
a good
do
time.
this. So yeah, wouldn't be the end.
Have a good time. You don't need your legs. Oh gosh, we're doing that thing where we start waffling at the end of an episode, Hamish.
Yeah.
Anyway, enjoy your time skiing, and we'll see you guys next. I'll see you guys next week. I'll see you in a couple weeks.
Yep. See you later, guys.
All right.